My name is Michelle Singson, and I am the Manager of Tax Operations at EWM Tax Solutions. Today, I'd like to talk about the basics of capital gains taxes. Capital gains are special in that, unlike wages, interest, or ordinary dividends, capital gains can be afforded favorable, that is, lower tax rates. A capital gains tax is a tax on the growth and value of an investment when a person or corporation sells that investment. When an asset is sold, we refer to the capital gain as realized. Unsold investments, or unrealized capital gains, are not taxed until sold. There are two types of capital gains. Long-term capital gains are assets that are held longer than 1 year. For tax year 2021, these are taxed at rates between 0 and 20%, depending on your tax bracket. Short-term capital gains are assets held less than 1 year and are taxed as ordinary income. This means you are taxed at the same rate as your regular earnings, such as wages or salary. Taxable capital gains can be reduced by the amount of capital losses incurred in that year. A capital loss is incurred when an asset is sold for less than what it was purchased for. The total of long-term capital gains, minus any capital losses, results in the net capital gain. Effectively, the amount capital gains that taxes are assessed on. As with any area of the U.S. tax code, there are exceptions. Some categories of assets are treated differently from a capital gains tax perspective. For example, gains on collectibles, such as art, antiques, jewelry, precious metals, or stamp collections, are taxed at a rate of 28%, regardless of your income. Another exception is real estate. When selling your principal residence, a certain amount of the gain on sale can be excluded from capital gains tax. This is dependent on your filing status, as well as the length of time you have lived in the home. Real estate held from investment is also subject to an exception. Since an investor is generally allowed to take depreciation deductions against income received for the property, this would ultimately reduce the amount considered paid for the property. Therefore, the capital gain realized when sold would be greater. The amount of depreciation claimed in previous years is then treated in the sale as depreciation recapture. This amount of recapture would be taxed at a rate of 25%. The remaining capital gain would be taxed as long-term capital gain rates. In any discussion of capital gains, we would be remiss if we did not make you aware of the net investment income tax. This tax imposes an additional 3.8% of tax on your investment income if your modified adjusted gross income exceeds certain thresholds. For example, for a filing status of married filing joint, this threshold is $250,000, or $200,000 if you are single or head of household. So what types of strategies are available to reduce or even eliminate capital gains tax? First, the easiest way is to simply hold assets for a year or more before selling them. This is because the long-term capital gain rates are generally lower than the rates for short-term capital gains. Be sure you are capturing the full costs related to sold assets, such as purchase and/or sale commissions. With the sale of real estate, this may require more diligence, and in my experience, many do-it-yourselfers often miss this. Another option is to use any capital losses to offset capital gains to effectively lower your capital gains tax. But what if capital losses are greater than gains? In this case, if your losses exceed your gains by $3,000, you can claim that loss against your income and roll the remaining loss over to reduce your tax liability in future years. The last option for today is the use of a retirement plan, such as a 401k, Roth IRA, or traditional IRA. Among the many reasons for holding a retirement account, your investments grow within them without being subject to capital gains tax. Within a retirement plan, you can buy and sell your assets, and you can grow your investment tax deferred. Most plans do not tax on the funds until they are withdrawn, and at that point, the distributions are generally taxed at ordinary income rates. If you are near retirement age, it is important to plan ahead to ensure you will not be subject to increased capital gains taxes. It may be beneficial to wait until you stop working to sell your assets, as your tax bill may further be reduced if your retirement income is low enough. If you are considering selling and think you may replace your asset with a similar asset, you may want to watch my video on like-kind exchanges. If you have questions or would like to discuss any of these tax-saving strategies, feel free to give us a call. Our team at EWM Tax Solutions would love to help you earn more, keep more, and live more. Thank you for watching. We look forward to hearing from you.